This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on trading in trading ranges. I want to talk a little bit about my 80% rule. 80% of the time when the market's in a trend, reversal attempts will fail. 80% of the time when the market's in a trading range, breakout attempts into a trend will fail. I think it's important to be able to distinguish a rally as being a leg in a trading range rather than in a trend, and the same is true for a sell-off. Is it more likely a leg that will become a trading range, or is it more likely a beginning of a bear trend? Trading ranges in general, you want to be buying in the bottom half and selling in the top half. Here's a 60-minute chart of the euro versus the dollar, and I want to use it to illustrate my 80% rule. Failed breakouts and reversals are more common than successful breakouts and the start of trends. Markets have inertia. They tend to continue to do what they've been doing, and they tend to resist change. And 80% of the time, even if you get a very strong breakout, it's going to fail. Strong breakout up, strong breakout up, strong breakout up, strong sell-off, strong reversal down. You have to bet that the breakouts will fail and the trading range will continue. Strong breakout up here, strong bear breakout, reverse up, strong bull breakout, reverse down, strong bear breakout, reverse up. You can see as soon as it breaks out, it's already hesitating. Strong bear breakout reverses up within a bar or two, strong bull breakout reverses down within a bar or two. There is a lack of consecutive strong trend bars, both in the bull swings and in the bear swings. Here we have a couple good bull bars and then a doji, a couple more bull bars and then a big bear bar. Where is the series of consecutive bull bars? We have a pretty good series here, but we have a doji here, fairly prominent tails, and then a big outside up bar that immediately reverses. This is not how strong trends look. Also, a lot of overlap. The bars retracing a lot of the move that occurred just before. A lot of small bars, prominent tails, dojis. That is more characteristic of a rally that's going to end up as a bull leg in a trading range instead of the start of a bull trend. When you see this, you have to be thinking that it's probably soon going to evolve into a trading range. Even though it's a strong bull trend as it's happening, it's probably a bull leg in what will become a trading range. And the opposite is true here. It looks like it's a bear trend, but prominent dojis, a lot of overlap, a lot of prominent tails. Yes, it's a bear trend, but it probably will end up reversing and forming a trading range. Big bear bar, but where is the immediate follow through and additional selling? We have a tight trading range. We have a big bull bar and then a big bear bar and then a big bull bar. We have a big bear bar here and a pair of dojis. Couple of big bear bars here and then a big bull bar and dojis and then prominent tails. Bad follow through. When the market's trying to break into a trend, the follow through is bad. That's one of the characteristics that the reversal or breakout is more likely going to lead to a leg in a trading range instead of the start of a trend. I'm always paying attention to whether or not traders selling with limit orders at prior highs or buying with limit orders at prior lows can make money. And if they can, then that means that the breakout is probably not all that strong, and it increases the chances that you'll soon get a reversal instead of the start of a trend. Here's a bull trend. We've gone up for about 30 or 40 bars, but the bears can make money many times during this rally if they use wide stops and scale in. And when that's the case, it's more likely a bull leg in what will become a trading range than a bull leg that will lead to a bull trend. At this point, when you look at this, you say, yeah, it's a bull trend for about 40 bars, but it's probably a bull trend that will be part of a trading range instead of the beginning of a bull trend that will continue up a lot further. Because of that, a lot of traders will look to sell above weak buy signal bars. We have a rally here for about 10 bars, but prominent tails on tops of the bars. And then we have a doji, high one, buy signal bar. And the bears who sold here and scaled in higher could make money. Therefore, there probably will be bears selling above this bar making money. And there might even be bears selling above this 2-bar pullback, this bull flag, who will make money. 2 bear dojis, not a strong buy. Other bears will not sell the breakout of the bull flag. They'll sell a breakout above a prior high, either here or above this high here, betting that the market will pull back far enough for them to make money. Other bears prefer stop entries, and instead of selling with limit orders at prior highs, they'll sell reversals down, especially a second or third reversal down, 1, 2, and then 3, and especially if the sell signal bar has a bear body, as it does here. Because the trading range is more likely than a bull trend or a bear trend, traders are going to take quick profits. And it's reasonable to take profits around a 50% pullback. Some traders like to take profits at some multiple of 10 pips. So take profits at 10 pips or 20 pips or 30 pips. We have a strong breakout here, probably going to get at least a small second leg up, but probably not much more unless we can break strongly above this high. I always look to the left, and if we have a strong breakout, but it does not break above all the bars to the left, it might be a bull leg in a trading range, and therefore traders will look to sell at a prior high and scale in higher. For example, if they're looking for a 20 pip profit and the market does not immediately give them the 20 pip profit, they may scale in more 20 pips higher and then look to get out break even on their first entry and then with the 20 pips profit on their second entry. The market has been selling off from this high for about 30, 40, 50 bars, and it's a bear trend. But look to the left. It's a bear trend, but it's within a trading range, and therefore it's probably a bear leg within the trading range. I always pay attention to whether or not bulls can make money buying during a bear trend. Can they buy at a prior low, scale in, and scalp out? And if it's fairly easy for bulls to make money in a bear trend, then the bear trend is probably a bear trend in what will become a trading range. It's a bear trend, but it's probably not going to continue down. It's probably going to reverse up and be a bear leg in a trading range. We're near the bottom of a trading range that has gone on for over 100 bars. Traders have been making money selling above bars, buying below bars. Here we're in the bottom half. Traders will look to buy. They'll bet on failed bear breakouts. One way to do that is you buy at a prior low, use a wide stop and scale in, betting that rather than this leading to a successful breakout below the range, it'll soon fail and reverse up. It might reverse up immediately and you can make a profit immediately, or it might go down a little bit further and maybe you can add to your position a little bit lower. If it does not go far enough down to add to your position, you simply hold and take your scalp profit. 20 pips might be a little small when you have a range that is as big as this, about 150 pips tall. However, it's reasonable because here we were in a smaller range within a bigger range, and maybe this will be a smaller range as well. We have a bear flag, bear breakout, a pullback. Some traders will bet that the bear flag will not lead to another leg down, and in fact it may even form a higher low, and they therefore will buy at the low of the sell signal bar for the bear flag. If it goes lower, they'll buy more lower, and if it goes up, they'll take their scalp. Here's an example. It did go 20 pips lower, and if you're looking for a 20 pip scalp, it's reasonable to buy more about 20 pips lower. If you're scaling in, first of all, beginners should not do it. Experienced traders will only do it if they're trading small. They don't want their risk on the trade, even with multiple entries, to be any greater than their risk on any other trade. The market gets back to their original entry price at the low of that bear bar. They get out break even on their first buy, and then they get out with a 20 pip profit on their lower buy. Other traders prefer to buy above a bull signal bar, and we have a bull outside up bar here. They might buy above that bull bar. They might buy above this bar, second entry buy. and went above this bull bar, broke down a second leg and trying to reverse up again, a small wedge bottom. So it's a second entry buy. First entry above this little bull inside bar, and the second entry above this little bear doji. Or if you prefer to buy above a bull bar, you buy above the high of this bull doji or above this bull bar. If the market goes 20 pips above your entry price, you take your profit. Sometimes when the market's in a trend, you'll look at a setup and you'll decide that it has very high probability of being profitable. Other times you'll look at a setup and say, that's a stupid trade. It's probably more likely to do the opposite. Maybe it's a 40% bet. When the market's in a trading range, a lot of the setups that you think are bad are closer to 50%, and a lot of the setups that you think are good are closer to 50%. The market is much more neutral. Whenever you're taking trades and you see that lower probability setups are being profitable more than you think they should be, you're probably in a trading range. Here we have a series of strong bull bars. You'd expect the market to continue at least a little higher. And we have a second entry short. It's an IOI. First entry is below the bull bar. Nobody's going to sell that. But now we have a second entry short with a pretty big bear bar, and it led to a profitable trade despite a very tight bull channel. Not a high probability short, probably a minor reversal in a trading range, but it was profitable. And that tells you that this entire rally is probably a bull leg in what will become a trading range. Here, you're buying a high one bull flag, maybe a micro double bottom with that low, in a strong bull trend. If it's a bull trend, you should be able to make money doing that. But if you're not making money, and then you have another buy, a second entry buy here, and that's also failing to make money, fairly high probability setups, they're not working. You have to be thinking that when you have a pretty good setup and it's not working, instead of a bull trend, this is probably a trading range. When you have a strong rally like this, your assumption has to be that either the market is going to be in a bull trend or in a trading range. You can bet against a bear trend. Usually a strong bull trend does not immediately become a bear trend, but it can have a very deep retracement of the rally. When that happens, you know you have big up, big down, big confusion, and probably a trading range. When the market is up here after this strong breakout, traders believe it's either in a bull trend or in a trading range. If it is in a trading range, it could have a very deep pullback to this low or even slightly below that low, but unlikely to become a bear trend. The bulls were hoping for a minor reversal and a bull flag, yet we got a swing down, a bear breakout below a high 2 bull flag, high 1, high 2. Probably we'll get at least 2 legs down, 1, pullback 2. When you see a high probability setup and it does not work, and then you see a series of high probability setups and they are not working, then they're not high probability setups. And that means the market is probably not in a trend. You have high probability setups and trends. If you see high probability setups that are not working very much, then you're probably in a trading range. In a trading range, the bulls and bears are balanced, which means setups are closer to 50-50. Low probability setups are not 40% anymore. They're probably closer to 50%. High probability setups are probably not 60% anymore. They're probably closer to 50%. We have a wedge bear flag, 1, pullback 2, pullback 3. And instead of leading to a breakout and a swing down, those bulls had a breakout and we ended up getting a measured move up. The wedge grew into 1, 2, 3, 4, and then a bull breakout and a measured move up. Low probability event. When low probability events are happening fairly frequently, the market's probably in a trading range. Strong reversal up. So instead of this wedge bear flag being the start of a bear trend, 1, 2, 3, or 1, 2, 3, 4, or 1, 2, 3, 4, 5 different ways to count it, you have a wedge rally. Instead of leading to a bear trend, we got a bull breakout. Probably a trading range, possibly a bull trend. I'm always paying attention to gaps. And in a trading range, gaps tend to close. They tend not to lead to measured moves. For example, here we are breaking out above this high. This close is above that breakout point, and therefore there's a gap between that close and this high. This low is right around that high, so there's a gap there, and the gap closed. We're stair-stepping up. More common if the rally is going to be a bull leg in a trading range, less likely if it's the start of a bull trend. We have a breakout point, we broke above it, we closed above it, we have a pullback that's holding above it or at or above it, and then we immediately close the gap. This pullback fell far below the breakout point. We have a rally and a breakout, yet look at the pullback, fell far below the breakout point. Because you're getting reversals falling far below the breakout point, then bears selling at the high and using wide stops and scaling in can make money. If the bears can avoid a loss by selling and scaling in, then the rally is more likely a bull leg in a trading range than in a bull trend. If the bears sell at a high and they are unable to make money, then probably the market's in a bull trend. We have an attempt at a double bottom, and we got a bear breakout, a gap between this close and that low. But look at the pullback, far above the breakout point. Therefore, the gap closed, and whenever you see gaps closing, it's more likely that the market is in a trading range than in a bear trend. Strong bear breakout, a series of bear bars, 5, 6 bear bars, closing far below the breakout point, yet we got a pullback above the breakout point. Therefore, more likely this sell-off is probably a bear leg in a trading range instead of the start of a bear trend. The bears trying to get a double top here, more likely they will fail and the trading range will continue. I think it's important to understand the distinction between strong rallies that are part of a trading range and not a trend, and strong sell-offs that are part of a trading range, not a trend. The market's trending up for 40 or 50 bars here, but it doesn't look quite right. The bulls lack conviction. We have tails on the tops of the bars. In absence of consecutive big bull bars, we have a lot of big bear bars. We have a strong breakout here, but followed by many dojis, so a lack of conviction that this is the start of a strong bull trend. We have a breakout, big tail, another breakout bar, big tail, a pair of dojis. This is not going up with a lot of conviction. The bulls are not confident that the market is going a lot higher, and therefore it's probably a bull leg in what will become a trading range. These tails on the tops of bars mean that instead of the bulls buying for any reason, buying breakouts and the market racing up, bulls are hesitant. They're taking profits at prior highs instead of buying more. And the bears are also confident that this is not going to lead to a big bull trend, and they're starting to sell at prior highs, betting that they can sell more higher, and eventually it'll pull back below the breakout point and they'll be able to make money. When you see that, the rally is probably a bull leg in a trading range. It's obviously a bull trend at this point, but there are a lot of features of this rally that are more typical of a leg in a trading range than the start of a bull trend. Because of that, even though it's rallying strongly for 40 or 50 bars, the entire rally will probably soon evolve into a trading range, which means it'll probably lead to a similar bear trend, which will also fail to become a bear trend. It'll be a bear leg in a trading range. The bears suspect that the rally is a bear leg in a trading range. And how can you possibly get a strong breakout like this if the bears believe it's a trading range? Well, part of the reason is the bears do believe it's a trading range, but they want to make sure that it's up near the top of the range before they sell. And therefore, you can sometimes have a vacuum up to where the bears are. So a buy vacuum The bears do not want to sell here in the middle of the range, but they do want to sell. They want to sell higher. The result is that you sometimes have a very strong breakout and then terrible follow-through when the market gets up near the top of the potential range, and then the bears sell and the bulls sell to take profits. This strong breakout is probably more due to an absence of sellers at this price. The bears want to sell, but not here. They're looking for a better price or a better setup. Therefore, traders look at this and assume it's strong bulls winning, when in fact it's bears being indifferent. They know the rally is going to fail, but they simply do not want to sell in the middle of the range. They want to sell higher. And then they overwhelm the bulls when it gets higher. Look at this rally. It's different from the rallies that I showed on the previous slide. Can you see what is different about it? It's a fairly tight bull channel. However, like a bull leg in a trading range, it lacks consecutive big bull bars, and it has a lot of bars with tails on top, so it has a lot of reversals. But there's one thing that's different about this. And that's what is taking place. The market's forming gaps, and the gaps are staying open. The market broke out above this high, and the breakout bar is not all that big. The follow-through is not all that good, but the bears could not close the gap. And the same thing here. We have a pair of bull trend bars. Neither one is very big, prominent tails on the top, and terrible follow-through, but the bears could not close the gap. When you have a rally that looks like a bull leg in a trading range, but you see 2 or 3 gaps staying open, it's probably a small pullback bull trend. And small pullback bull trends are one of the strongest types of bull trends, and they can go up a long way. If you see a weak rally and you think it's a bull leg in a trading range, but it's forming gaps and the pullbacks are small, lasting only 1, 2, 3 bars, you have to bet that it's probably a small pullback bull trend, not a bull leg in a trading range, and it can go a long way, and therefore do not sell. One of the gaps often leads to a measured move. We have a gap here, this low, and the breakout point, a double bottom, this low, that low, and the market rallied to about a measured move up. Compare what I just showed to this. We have a sell-off lasting 30 bars maybe here. Also, it looks weak. We have bull bars after the bear breakouts. The bear breakouts are not all that big. We have prominent tails on the bottom of the bars. We have dojis here, tight trading range, tight trading range. It looks like a bear leg in a trading range. We have a gap this low, that high. But look to the left and we're still above prior lows. The reason why this sell-off looks weak is because the bears lack conviction, especially near the bottom of the range. They are not confident that the market will successfully break below the bottom of the range. They believe that there will soon be a reversal. The bears are taking profits, and that's why we're getting this hesitation instead of a strong, relentless breakout below all support. The bulls see the strong sell-off. They know it's not going to be the start of a bear trend. However, they also believe they'll be able to buy lower. Therefore, this sell-off in part is due to the bulls not willing to buy at this price. They're very eager to buy, but not at that price. And therefore, the sell-off in part, or possibly in large part, is due to the bulls not willing to buy at this price. Lower down, they eventually overwhelmed the bears. This is not enthusiastic bears. There's hesitation on the way down, tails below the bars. The reason why it's not turning up is because the bulls are not yet buying. They did buy here and they did buy there. Now, how is this sell-off different from the one that I just showed? Very tight bear channel. However, it lacks consecutive big bear bars. It has consecutive bars here, but they're not all that big. Lots of reversals, lots of bull bars, tails below bars. Yet, why did it go down for so many bars? Because of what I said a moment ago about small pullback bull trends. We have a gap. We have a breakout below this low, and the pullback could not get above the high. We broke below this low and that low. The pullback reached above that low and went a little bit above this low, possibly a negative gap, and reversed down sharply. It's a small pullback bear trend. The pullbacks here lasted 5, 6, 7 bars, but here only 1 bar, 1 bar, 1 bar here, 1 bar here, and we're getting these gaps. If you start to see 2 or more gaps in a trend, and the trend does not look all that strong, it lacks consecutive big bars, but those gaps tell you that the trend might be a small pullback bear trend, and if it is a small pullback bear trend, it's one of the strongest types of bear trends, and it can last a lot of bars, and the market can fall very far. Do not buy new lows. If the market is forming gaps, bulls cannot make money buying new lows. Do not buy. Instead, expect some kind of a measured move down. Here, gap, measured move down. You can see some buying at the measured move. I talked about several signs that this is a trading range rather than a bull trend or a bear trend. And those signs are created by how traders are trading. Traders believe that no matter how strong the sell-off is, it'll fail to lead to a strong bear trend. Even if it breaks below this low, they bet that it's going to reverse up. And they also expect that any rally, no matter how strong, will also reverse. And therefore, traders are not willing to buy high. They're not willing to sell low. They do the opposite. Bulls buy low to initiate a long position, and the bears buy low as well to take profits because they do not believe it's a bear trend. Near the top, the bears start to sell high because they don't think it's going to lead to a bull trend, and the bulls sell high to take profits because they too are not confident that it will be a bull trend. It looks like a bull leg in a trading range. We're near a prior high. We're in the upper half of the range, probably not going a lot higher. When the market looks like a bear leg in a trading range, bulls will buy strong bear closes, betting that the gaps will fail and the market will reverse. Other traders prefer to buy reversals up, especially above bull bars, like here. However, the bulls, when they buy, are not confident that it'll lead to a bull trend. They believe it's more likely going to be a bull leg in a trading range, especially after a tight bear channel lasting 15 or 20 bars. The bears know that as well, and the bears will sell any sign of strong bulls near the top of the range, or other bears, especially beginners, should only enter with a stop, selling on a reversal down. Above this high, bulls will take profits, doubting it's going to be a bull trend. Bears will sell, looking for a scalp. And the same here as well. Sell at that high, bulls take profits. Bulls will also take profits at strong bull closes, and bears will also sell at strong bull closes, like here. Strong bull breakout above the high. Bulls will use it as a gift. They'll see it as a gift. Wow, I wasn't expecting that, but we're still not closing above the top of the range. Most trading range breakouts fail. This is more likely to fail than to be successful, and therefore if you're a bull, you're going to take profits at the close of a very strong bull bar near the top of the range. And an aggressive bear will sell there. We have a doji inside bar, big tail up here, big tail on top of the doji bar, a terrible looking high one bull flag, probably will reverse. Bears will sell with a limit order at the high of that bar, even though it's a high one bull flag. They'll bet on a reversal and bet against a breakout. Traders, bulls and bears, are confident that the moves up and down will not go very far, and therefore they'll take quick profits. Some of these legs last 30 or 40 bars, and you can take a swing trade. However, you're not going to hold forever. you're going to expect the market to reverse up when it's near the bottom and reverse down when it's near the top. Trading range, buy low, sell high. In general, try to buy in the bottom half or bottom third and sell in the top half or the top third. Clear trading range price action here. Traders are going to be looking to sell in the top half of what they think is the trading range. The bulls will take profits in the top half, and the bears will sell to make a scalp trade down into the bottom half. And when the market's in the bottom half, the bulls buy reversals up, and the bears take profits. It became a bigger trading range. We reverse down here, second reversal. Bulls will take profits, bears will sell. We sold off strongly, 3 legs down, 1 pullback, 2 pullback, 3. Big bear reversal, probably at least a small second leg down. We're now in the bottom of a possible trading range. This looks more like a bear leg in a trading range. Plus, most reversals result in trading ranges and not bear trends. Bears will buy back their shorts on a reversal up, and bulls will buy as well, betting against the breakout. The trading range continued, and when the market's near the top, traders will look to sell reversal down, especially a second or third sell, and especially below a bear bar. Here we have a micro triple top. Traders will sell below that bar. With both the bulls and bears buying low, and both the bulls and bears selling high, and both taking quick profits, the result is the market goes sideways. It creates a trading range. And when you see evidence of a trading range, you should do exactly what the institutions are doing. They're buying low, betting against bear breakouts. They're selling high, betting against bull breakouts. And they're taking quick profits because they think the market is not going to break out of the opposite side of the range. Buy low, sell high, scalp. That's what this acronym is. Trading ranges often have very deep pullbacks. Very strong rally, but a lot of characteristics of a trading range, and therefore it could have a very deep pullback. Very strong sell-off, but it looks like a bear leg in a trading range, and therefore it could have a very deep pullback. A pullback in a bear leg means a rally. A lot of traders prefer to sell in the top third of the range and buy in the bottom third of the range, not just the top half and bottom half. Here's the top third of a possible developing range. Here's the bottom third. Traders will look to buy in the bottom third, sell in the top third. Here, after this reversal down, we know that the top third is up here. Traders will look to sell in the top third. And we know the bottom third is down here. They'll look to buy in the bottom third, either with limit orders or on reversals up. The stop oftentimes is far. If you're buying, the stop is at least below the bottom of the range. And if you're selling, the stop is at least above the top of the range. So the risk is oftentimes relatively big. That means the risk reward is bad. However, most breakouts fail, and that means the probability of selling high and buying low is high. That's your trade-off. You're not going to make much money. The stop is often further away, so the risk-reward ratio is bad, but the probability is high that you're going to get the reversal, and therefore the probability of making a profit buying low and selling high is high, and it more than offsets the bad risk-reward. A stop order is a bet on a breakout and a trend. A limit order is a bet that the breakout will fail and will reverse. In a tight trading range, if you're scalping with stop orders, you're going to lose. You cannot be buying at the high, betting on a successful breakout. You cannot be selling at the low, betting on a successful bear breakout. Trading ranges often contain many very tight ranges here and here. Here's another tight range as well. And when the market's in a tight trading range like this, reversing every 2 or 3 bars, it's very difficult to make money buying with stops, especially near the top. Very difficult to make money selling with stops, especially near the bottom. It's a limit order market. It's easier to make money buying above bars in the top half, betting the breakout will fail, and buying with limit orders in the bottom half, betting that the bear breakout will fail. Beginners should not be doing this. This is something that experienced traders will do. Selling above prior highs, betting the bull breakouts will fail, selling with limit orders at the top of the tight range, buying with limit orders at the bottom of the tight range. A limit order entry is a bet against a breakout, a bet against a trend. Sometimes you'll see a very strong buy signal bar, but it's forcing traders to buy near the top of the range. And if the bar is big, the stop is far away. And if you're buying at the top of the range, the probability is low. That's bad math. You have a stop far away, so your risk is big. And the opposite is true at the bottom of the range. Here we have a very strong bull bar reversing up from the bottom of the range, but all of the price action to that point looks like a trading range, and this is near the top of the range. Therefore, if you buy above the high of this bar, you stop as far away, and you're buying at the top of a range. The probability is the breakout will fail. So you're taking a low probability bet with a lot of risk. And that's the exact opposite that you should do. You cannot have both risk reward against you and probability against you. Therefore, even though you have a strong bull reversal bar, there probably are more sellers above the high of the bar than buyers. If it's a bad setup for a stop entry, then it's a good setup for a limit order entry. I began by talking about my 80% rule, and that is that 80% of the time, strong breakouts in trading ranges will fail and reverse instead of breaking out. I then talked about characteristics of legs within a trading range and distinguished them from legs within trends. When the market's in a trading range, traders want to buy in the lower half and sell in the top half. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on trading in trading ranges.